Hey, welcome back. It's Jason Waldry here. More records were broken, and in today's housing market update, I'm going to be sharing all the latest reports with you. I have an update regarding home prices across different cities in the nation. I also have a big update regarding mortgage loan forbearance numbers because those dropped big time lately. Before we get started with today's video, for those who know me, you know that I'm a real estate agent, but I only cover the greater Sacramento area. So that's why I teamed up with homeandmoney.com because they have the best agent referral program I've ever seen. So if you want to get linked up with a great agent in your neck of the woods, regardless if you want to buy or sell a house, then go to homeandmoney.com/Jason and get started today. And the best part about this service is 100% free. Okay, let's go ahead and dive into the video, and I want to share a report from the National Association of Realtors. They just released this report today, and this is for metro home prices for the first quarter of 2021, and a lot of these numbers are jaw-dropping. All right, so get this. So nearly every single metro area that the National Association of Realtors tracks had a home price increase in the first quarter of 2021. That represented 99% of all the metros they track. So in other words, only 1% of those areas had a home price decrease in the first quarter. How nuts is that? In addition, 89% of the metro areas had a double-digit price gain. And here's another stat I want to share with you, which is absolutely nuts. While 89% of the US metros had double-digit price gains in Q1 this year, for comparison, only 25% of metro areas saw this level of growth in Q1 of 2020. So in other words, more than 3 times more metros had double-digit price growth this year compared to last year. This goes to show how widespread this US housing market has been surging. Lawrence Yun, who's NAR's chief economist, stated the following: "The record high home prices are happening nearly across all markets, big and small, even in those metros that have been considered off the radar in prior years for many home seekers." And the top 11 US metros that had the highest price gains were the following. Those were Kingston, New York, with a 35.5% home price increase there. We have Bridgeport, Connecticut, Atlantic City, New Jersey, Barnstable, Massachusetts, Boise, Idaho with a 33% increase, Sherman, Denison, Texas, Elmira, New York, the Austin, Texas area with 28% increase, Youngstown, Ohio, Decatur, Illinois, and then finally Glen Falls, New York with a 27.5% increase. In addition, the most expensive markets in the US also have experienced double-digit price growth. So those areas are the following. That would be San Jose area in California with a $1.5 million median home price. Absolutely insane. San Francisco, Oakland, Hayward area, that would be San Francisco including parts of the East Bay, with a median home price of $1.2 million and an increase of 21.8%. Absolutely insane. Anaheim, Irvine, California area with a median home price of $1 million. And then Honolulu here. I didn't know that home prices there were that expensive, but $940,000 is the median home price in the first quarter of this year. San Diego with a 14% increase, and Boulder, Colorado, $726,000 there. Los Angeles, Glendale area of California, they had an increase of 15%. Seattle had an increase of 18%. And look at Naples, Florida area, a 25% increase. Then we have Suffolk County area of New York with a $600,000 median price and an increase of the median home price by almost 23%. On a national level, home prices increased 16% on a year-over-year basis to $319,000, which is a record high since 1989. All regions recorded double-digit year-over-year price growth, with the Northeast surging 22%, followed by the West, South, and then the Midwest. I think many of you would agree with me on this, but home prices cannot increase at these levels forever. This is not normal for home prices to gain by more than 20%, even 15%. So at some point, home prices have to decrease, but it's anyone's guess when that's going to happen. We honestly need more housing inventory or for interest rates to increase to cool off this red-hot housing market. NAR's chief economist stated the following, so let me know what you guys think about this. He said these higher home prices underscore the importance of stepping up housing supply. An increase of inventory either by new construction or by converting abandoned and unused retails or hotels would combat the affordability problem. I 100% agree that we need more housing inventory, and a big portion of that should be coming from new home developments. We also need a big increase from the resale market, meaning homeowners deciding to sell their houses. But the big problem there is, where are they going to move to? They can buy a house, but the lack of housing inventory makes it very hard to buy a house if you want to sell. In addition, the rental market across many markets across the nation is very scarce as well. However, converting unused retail space and hotels is very, very expensive given the fact that housing construction is very expensive right now. For example, think of a hotel that doesn't have any kitchens in it and converting that into an apartment building with a kitchen in each unit. That'd be extremely expensive, so I don't know how viable this option is. However, I'm just a guy on YouTube. I'm not in the construction business, so let me know what you guys think. All right, so going back to this report from the National Association of Realtors, it states that nationally, a family typically needed an income of about $51,000 to pay for a 30-year fixed-rate mortgage with a 20% down payment. They needed $48,000 1 year ago. But get this, there are 8 US metros where you would need more than $100,000 in income in order to afford the median home price there. Those areas are the following. That would be San Jose, Santa Clara area, where you would need $242,000 to afford a house there to buy. San Francisco, Oakland area, where you would need a $194,000 income. Anaheim, a $161,000. And get this, urban Honolulu, you would need $152,000 to buy a house there. San Diego, $123,000. Boulder, $117,000. Los Angeles area about $110,000, and then Seattle $105,000. Okay, let's discuss the latest news regarding mortgage loan forbearance numbers because they dropped big time lately. Black Knight reported that the number of homeowners in forbearance dropped by 100,000 last week. So now 2.2 million homeowners are in forbearance, and that's down from almost 5 million from almost exactly 1 year ago. We also may expect more homeowners to end their mortgage loan forbearances in the months to come. This is because approximately 73,000 plans are still listed with April expirations. Also, another 350,000 forbearance plans are set to be reviewed for extension or removal in May. That number climbs to nearly 900,000 in June of this year. Currently, there are 697,000 loans in forbearance where the loan is backed by Fannie Mae or Freddie Mac. There's also approximately 900,000 FHA or VA loans in forbearance, but here's what I find to be most worrisome, and a lot of people don't talk about this because the number of homeowners in forbearance in the other category currently are 627,000 loans in forbearance, where the vast majority of those are not in federally backed mortgages. I mention this because the CARES Act that was passed in March of 2020 only protects those that have a federally backed mortgage, meaning a loan that's backed by Fannie Mae or Freddie Mac, an FHA, VA loan, or a USDA loan. One of those protections in place is that they do not have to make a lump sum payment when they exit their mortgage loan forbearance. As far as I know, there's no similar protection for those who do not have a federally backed mortgage. Therefore, for these 600,000 plus homeowners who are in forbearance without a federally backed mortgage, I'm really curious what repayment options are afforded to them. Will these loan servicers allow these homeowners to do a loan deferral, for example, meaning they pay back all their missed payments when they refi or sell their houses? Or will they be forced to do a one-time lump sum payment to pay back all their missed payments when they exit their loan forbearance? For those who are still having a financial hardship and end their forbearance, these people may potentially be in trouble depending on what type of repayment options are afforded to them. If anyone has any insight regarding this, then please leave us a comment below. What we know so far is that out of all the people who have ended their mortgage loan forbearances through the period May 2nd, 2021, only 14.2% paid off all their missed mortgage payments with a one-time lump sum payment. And that's what the Mortgage Bankers Association posted yesterday, regardless if the homeowner had a federally backed mortgage or not. In addition, out of all the forbearance exits through May 2nd, 2021, according to the MBA, 26.9% resulted in a loan deferral or partial claim. That means you pay off through either selling or refinancing their mortgage. In addition, 25% represented borrowers who continued to make their monthly mortgage payments during the forbearance period, even though they didn't have to. And 15% represented borrowers who did not make all their monthly payments and exited forbearance without a loss mitigation plan in place yet. Let's hope these homeowners reach out to the loan servicers ASAP, otherwise these homeowners may be in trouble. And by the way, on a side note, this 14.8% number, what we don't know is how many of those people eventually entered into a loss mitigation plan with a loan servicer. So we don't know if they completely disappeared and they may face foreclosure eventually, or if they eventually reached out to the loan servicer and entered into a loss mitigation plan. Additionally, out of all the loan forbearance exits, approximately 9.8% resulted in loan modifications or a trial loan mod. And we had 7.5% that resulted in loans paid off through either a refi or by selling their houses. So in other words, very few people have either sold or refied when they ended their mortgage loan forbearance, at least so far. The remaining 1.6% resulted in repayment plans, short sales, deeds in lieu, or other reasons. I also noticed a study from CoreLogic regarding forbearances, and I want to share that with you. So according to CoreLogic, a typical homeowner in forbearance appears to have a sizable equity in their houses, with median equity of just over $100,000 and a loan-to-value ratio of approximately 61%. If you take into consideration all the missed mortgage payments and assume that gets added to the outstanding loan balance, then the home equity decreases to $88,000. At these levels, you would have more than enough money to cover the cost of selling your house, and you would still have more equity left over. Obviously, the longer the homeowner has owned their houses, though, the more in equity the homeowner would have. But according to CoreLogic, even for newer homeowners, those who have purchased their houses in 2019 or later and represent 15% of those in forbearance, also have notable equity gains averaging over $65,000 for a typical borrower. If you enjoyed watching this video, then please hit the like button. I greatly appreciate that. And also consider subscribing as well. You also can follow me on Instagram. I'm Sacramento Realtor. Hope you have an awesome day and I look forward to seeing you on the next video.